Are you curious how to invest for retirement? Do you want to live through your golden years knowing that you'll have enough retirement income to last for the rest of your life? Or are you okay with an if strategy? Hi, I'm Matt with Carlin Financial Group. For the best retirement information and to help make sure you don't outlive your money, subscribe to our channel and ring the bell to be notified when we post new videos. A few years ago, I met with a gentleman to discuss retirement investment options and strategies, and he was about to retire from a very prominent company, which will remain unnamed, with a good amount of money saved. He had some very specific goals and a pretty solid idea of what kind of income he needed or wanted in retirement to meet those goals. He was 65 at the time, and he was a very nice gentleman, excellent health, with a lovely family. I talked with him about the importance of having a lifetime income that would see him through those retirement years, about the importance of having a plan for unexpected roadblocks like the cost of health care, inflation, the possibility of increasing taxes. Over the course of our visit, he also indicated that it was important to him to leave a legacy for his kids. But when we dug into the numbers a bit, I found that he had a diversified portfolio of equities and bonds, a portfolio very similar to many I've seen over the years in 401ks or other qualified retirement plans when people first come to visit with us. It was likely a portfolio that had served him well over the years as he worked to accumulate wealth and prepare for what he and probably all of us strive for, is a safe and stress-free retirement. Before coming to visit with me, he met with the administrator of his retirement account, and they gave him a projection of how long his money should last in retirement based on how much income he needed. He shared with me that their numbers showed that his rather substantial retirement account would probably last him until he was age 80. For me, there are two things very worrisome about that statement: the word probably and the age 80. I asked him how comfortable he was knowing that his current retirement investment strategy offered no guarantees that he would be able to provide for himself and his family for the rest of his life, and in fact that his money would likely only make it to age 80, when he shared with me that most of his family lived well into their 90s. As with most people, he was not very pleased with the idea of running out of money during his lifetime. Initially, he was convinced, even after hearing that his income would not last as long as he did, that leaving his money fully invested in the market was the way to go. He'd listened to several financial entertainers like Dave Ramsey, who told him that this was bar none the best way to do retirement. How can he say that? Well, because the market has proven to provide positive returns in the long run. So what could be wrong with this retirement investment strategy? For starters, let's focus on the long run portion. Here, you can see that indeed over time the market has provided a positive return. But you can also see that there have been times in history where the market was negative, sometimes for brief intervals and at other times for a far more extended time frame. The problem here is we never know when those negative returns are going to occur or how long they may last. So, he asked, is the stock market a good place to invest? Well, over time, of course it is. If time is on your side and you're a long-term investor that can survive the ups and downs. I'm not suggesting that you should never invest in the stock market. In fact, I believe you should always likely have some money invested in the market. Money that you can afford to put away for those periods of growth, but not all of the money that you'll need to rely on for the rest of your life. I then shared with him that while Dave Ramsey and others like him frequently have some very valuable advice to share, they're in the business of giving very broad suggestions to a large audience, and not all of that advice pans out for every investor. To demonstrate the potential flaw in Dave's leave it at all at risk in the market approach and how the timing of your retirement and how it coincides with the potential market downturns that could affect the longevity of your money, I shared a few examples of that advice in action. Before we look at those, we do dig into a bit more about sequence of returns risk in another video that you can check out. Now, For each of these examples, we'll look at someone who starts with $375,000 invested in an S&P 500 index fund with an annual income need of $30,000, adjusted for inflation over a 30-year retirement. So first, let's take a look at what would have happened if this person retired in 1980 using that strategy. As you can see, Dave's looking like a pretty smart guy right now, and our friend fared quite well and still had a sizable sum of over $2 million to leave on to his family. But let's see what happens if that retirement had started 10 years later in 1990. Well, for a while, things seemed to be going pretty well, but then the market experienced a rather prolonged downturn. And in this case, our friend would have been completely out of money by 2013. Well short of the 30 years he'd planned for the income to last. That let it roll and keep it all on the market strategy doesn't look quite as appealing during this time frame. Finally, let's take a look at this same simulation, but with retirement beginning in the year 2000. Here, you can see that due to the sequence of negative returns early in his retirement years, his money didn't even last a full 10 years. Far short of not just the 30 years he'd planned for, but also likely well short of his lifespan. In this scenario, Dave's advice isn't looking so great anymore. Our friend, who was hoping to experience a similar outcome to someone that had the good fortune to retire at a good time, is not likely to be very pleased with the fact that his hard-earned savings have been depleted in such a short time. What I shared with him and what I'm now telling you is that retirement is a fundamental shift in life that requires a fundamental shift in the way you think about your money and risk. Why? Because time is no longer on your side, and it's not something that you can buy more of. Now, during your working years, you got a paycheck, and you were able to add to your savings, and you had time to weather the volatility of the market. In retirement, your savings are typically what provided your paycheck, and the very last thing you want to be forced to do is sell during a market downturn, because it both locks in a loss and inhibits your chances for the future growth and sustainability. So the tools and strategies that got you up that mountain and to retirement are likely not the same set of tools and strategies that will get you successfully down the other side. Life brings changes, and one of the biggest changes you will experience is transitioning from your income earning years to your retirement years. So what I'm telling you is that in most cases, it is time to stop doing what you've always done and think about a new plan. A plan that will consider guaranteed income, healthcare cost, what will happen to your money when something happens to you, and in today's world especially, tax strategies. Financial advisors are not miracle workers. If you've saved $1 million for your retirement, that's what we have to work with. I can't promise you a $200,000 a year income from that $1 million, but what we can do is work within the framework of what you have and what your goals are for you and your family, and help develop a strategy to meet those goals. For most people, that strategy will involve some discussion of how the retirement shift could and should affect how you position your money. Typically, you'll need to set aside the money you need in the near term, say the next year or few, in cash, savings, money market accounts, something of that nature that you'll always have access to, but is not at risk of loss. Then you might look to dedicate a portion to your more intermediate and or income goals. This portion is something you'll want to be protected from market risk, but you still grow. And finally, the longer term money that you won't need anytime soon could be allocated to a growth-focused strategy where you'll look for those long-term market returns to work for you. As I sit here today, the markets are near record highs and have performed quite well for a number of years. It's been easy to make money and to grow complacent about market risk, which is all the more reason to be aware of the potential for a correction and to have a plan that will help ensure the longevity of your retirement savings. A plan that means you won't have to worry about the what if there's a correction or what if the market keeps dropping scenario. I can tell you, sometimes the markets will continue to fall and sometimes they won't. I was an advisor when the tech bubble burst in the 90s. I was there for Black Monday. I was there for the lost decade. I'm still here today and doing okay. And so are my clients. That's because we took the time to develop a plan for the fundamental shift in life that is retirement. Now, if you have more questions about how you should prepare for this shift, let us know down in the comments. We'll do our best to get those answered for you in a future video. If you're ready now to explore what changes might need to be made in your financial plan, or simply get a second opinion on where you stand, you can find out more about working with us and apply to become a client by visiting the link below in the description. I know it's not easy. Sometimes talking about change, people tend to resist change, especially at a time in our history when the stock market has given us amazing results. If it keeps doing that, if it keeps doing what it's done for the last 12 to 13 years, for the next 40, you'll probably have a financially sound retirement. But that is a very big if. Is that really what you want to base your retirement and your future on? Thanks for watching today. And if you know someone this video may be helpful to, please share it with them. Give it a like. And don't forget to subscribe to our channel so that you won't miss out on any future valuable tips. And as always, live today, plan for tomorrow.